And a very good afternoon to you. My name is Nick the Moose Batsman. I'm the Commander-in-Chief of TIP TV. Welcome to the Wall Street Crossover Show, brought to you by TIP TV in conjunction with our sponsors, Admiral Markets. It gives me great pleasure to reintroduce Mr. Darren Sinden, market commentator for Admiral Markets. Darren, how the devil are you, sir?
Very well, thank you, Nick.
Quick recap. Obviously, markets a bit soggy this morning. China continues to be a theme, as do interest rates, as do deflation. Well, we could probably talk for an hour on.
Well, we talked yesterday.
In the world. We
thought that maybe Greece was going to, overtake China this week as the topic du jour. But famous last words, because China's come back into the spotlight. Yes, interest rates and inflation also, are in focus. I personally don't think there's any change from what we've seen today. We'll come to that in a little bit. I stay on the same course. I think rates stay where they are till 2016. At least, and we possibly have some kind of correction in equity markets in the interim.
Understood. Okay, if you're watching for the first time, we've got a number of slides that we'll go through. Let's kick off with the first one today. We've got data released over the European session.
Okay, well, it would be remiss not to just flag what we just talked about. Again, the big movement in Chinese equities. Shanghai Composite Index was down 6.2% overnight, and as I understand it, that was even as the People's Bank of China added liquidity to the system, not specifically to the equity markets, but to the money markets as a whole. But it just shows you, however good your propping up of a market is, it will inevitably find its own natural level.
Yep.
And that appears to be what's happening here. That will, rumble around the world for a while yet. Staying in Asia and staying with stuff that happened before the European Open, we had new vehicle sales in Australia. Obviously, new vehicle sales in China and America have been key to European car makers, but it's also important for them to see growth in other developed economies such as Australia. So for the figures for July, month on month, actually down 1.3%, contrasting with a healthy 3.8% gain over the previous months. Looking at the history of this monthly figure, it's very erratic. It swings, either side of the gain line very regularly. Okay. So it's probably better to try and get a handle on what's happening on a year-on-year basis. Well, the trend is down slightly still. 3.7% the growth year-on-year in July of new vehicle sales. That was weaker by just 7-8% than the prior read of plus 4%. So the questions about the Australian economy remain. It's obviously under a lot of pressure, thanks mostly to China and weaker commodity prices and the strong US dollar, I should say. So again, those are the kind of numbers that people will be watching going forward. And then back into Europe, it was a pretty thin day for data from mainland Europe, but we had plenty to contend with looking in the UK, particularly inflation data, and a whole raft of numbers here. I picked out a few of them and I hope I won't bore people running through the lot. First of all, producer price inputs year on year, down 12.4%. Sounds dramatic, doesn't it? But the forecast was down minus 12.8%, so we beat that. We're also ahead of the prior read of minus 12.6%. But not surprising, really, that the input prices are down for a lot of the reasons we just talked about. Commodities, have fallen sharply. And that's the factor behind that. Has that translated into output prices as far as producer prices are concerned? Well, to some extent, yes, it has. Producer prices on the output side fell by minus 1.6%. That was actually slightly worse than the forecast, minus 1.5%, and the prior figure, which was exactly the same, minus 1.5%. And then the two numbers that
the headline makers.
Yes, that most people focus on. Firstly, core CPI. So this is the tighter measure of consumer inflation. And that was at 1.2% against the forecast of plus 0.8%, and indeed the prior read of plus 0.8%. So that set pulses racing. The broader measure of CPI, though, was a bit less compelling, plus 0.1%, though better than the forecast unchanged in the prior read of 0 as well. So net cable, as we'll see later, has taken heart from that and has rallied on the back with the expectation of a rate rise coming sooner rather than later. I think that fades personally, because I don't think the data is strong enough to justify that yet.
Understood. Let's move on to European movers.
Okay, well, actually, for a change today, we've picked on two UK names. First of all, House Builder Persimmon, ticker PSN in London. 2094 down 1.27%. That might come as a surprise given that half-year profits were up by 31% pre-tax, and both sales volumes and prices were improving. However, as Bovis, one of their competitors, said yesterday, a shortage of skilled labour and associated costs, rising costs associated with that, I should say, are perhaps potential barriers to growth. So they've got demand for houses and they can sell them at high prices, or they might not be able to build them as quickly because they haven't got the right skill sets amongst the workforce.
Understood. And Antos?
Antofagasta, a copper miner, listed in London, based predominantly in Chile. China weakness and copper at 6-year lows, and they're down 2.35% at 560 on the day. And you know, the more upset we have in China and lower commodity prices go, unfortunately the lower some of these mining prices are going to go too.
Understood. Let's talk about M&A, the rumours and movers this morning.
Okay, well, it's we talked about a transatlantic deal yesterday, and here we're talking about something that's trans-Pacific, I suppose. Brookfield Asset Management, ticker BAM in the US, trading around $34 US dollars 50 days, is going to acquire the Australian ports operator Asciano. It's ticker AIO in Australia, trading around $8.69. Brookfield's going to pay roughly 8.9 billion Australian dollars, I should say, which is the equivalent of 6.6 billion US. In terms of the outright valuation for the deal, Asciano shares will be valued at around $9.15. That came in at the deal came in at a 13% premium to Friday's close, so it's quite a nice boost to the fortunes of Asciano shareholders. The deal was first mooted back in early July, since when Asciano actually reported better than expected progress. I think they're actually up by about 19% above analyst forecast, so it was a healthy improvement for there. Thinking in the market now is that perhaps other Australian trophy assets, if I can even say that, might be up for grabs. This is the largest cross-border deal into Australia since 2011, and you know, it's seen as something of a vote of confidence in the long-term future of both the Aussie coal industry and other commodity-related businesses there. Brookfield takes advantage of obviously depressed pricing for the reason that you know we talked about, and a weak Australian currency. There will need to be some regulatory approval for the deal, but Brookfield, which is actually a Canadian company, will list itself in Australia, and it is offering shareholders cash or paper alternatives. So it's, you know, it's trying to make itself friendly, and it's, by the sounds of it, it's there for the long term.
Understood. Let's now talk about US data points to keep an eye on today.
Again, a fairly thin day for data in the States, but we've got housing starts and housing permits, probably the highlight. So for starts, we've got a forecast of 1.18 million against the prior read of 1.174 million. And then in terms of permits, the forecast here is for 1.23 million against the prior read of 1.343 million. Housing starts and permits have both been trending higher really over the course of 2015. And then our old friend Redbook chain store sales, and I think the thing here, particularly in this week, is that it's such a big week for US retail earnings. That might actually be a better guide to the health of the US consumer.
Right.
Walmart's just reported before we've come on air, and they've actually guided lower quite sharply. So that might set the trend for the rest of the bunch over the course of the week.
Understood. Let's take a look at US pre-market movers and some chart levels.
Okay, so we're staying with the retail theme. A couple of smaller apparel retailers reported last night. First of all, Urban Outfitters, ticker URBN in the US. This is one of those Marmite stocks, gets lots of press coverage for people who either love it or hate it. Trading around $31.50 after hours last night, down by about 2.26%. The numbers were better than expected, but here's the rub here: sales growth is likely to fall quarter on quarter, and that's raised a few concerns because this is the back-to-school quarter, and this is one of their busier periods of the year. It's a company that targets a younger demographic, which is why this is important. Interestingly, the stock had rallied sharply in hours, but corrected once the news about potential falling sales came out. But it could be worse. It could be in American apparel, APP, US, the ticker there. Again, probably has one of the stocks with a predominantly younger demographic, but it's struggling. 12.5 cents only, down 16.5% after hours. and the company admitted that it may not have enough cash to continue trading over the next 12 months as losses mount. To put that in perspective, it's lost around $19 million recently. It's got just under 12 left in cash in the bank. So something's got to have to change there, and it could be that the shop folds completely.
Understood. Chart levels?
Not that much going on in Europe today. Actually, we've taken the move in China quite well. Just a slight adjustment to some of the levels here then. So FTSE, we've gone with 6,500, plays 6,570. The DAX, we're now looking at 10,880, plays 10,980. So we have slipped finally completely below the 11,000 handle.
Yep.
The S&P and the Dow were both better last night and closed near the highs. So we're 2080. Plays 21.15 now to the upside in the S&P, and for the Dow 17,470 is our downside level, plays 17,560 to the upside. Currency wise, a little bit weaker as far as the euro is concerned, so 110.30 now on the downside, plays 110.98 to the upside against the dollar. Aussie seems happy enough to stay above 73 for the moment, so Aussie US dollar 73.30 on the downside, plays 73.65 to the upside. Dollar yen, it's all really run out of a bit of steam over in Japan, trading in a very narrow range, 124.10 to the downside, 124.55 to the upside, just looking for something to make it move. Yeah. And cable, as I said, that rallied on the back of the inflation number, so 156.41 our downside level, plays 157.15 to the upside. As I say, I think the rally fades, but let's see what the market says.
Okay, so let's just wrap up with the final slide, in focus.
Okay, so a new slide, and we're going to try and put this in. We've got something that we think's worth highlighting and worth looking at. So what are we watching? We're watching WTI, US crude, West Texas Intermediate, 41.68 was trading shortly before we came on air. Just to flag really that crude is down 20% plus year to date as of the close on Friday. Our point and figure model, or the Investors Intelligence point and figure model that we use, has a target price in the midterm of as low as $25. The drilling rig data from the US, which comes out on Friday, was up. So last Friday's data was up for a fourth week in a row. So more drilling rigs are being deployed onshore in the US, onshore and offshore, I suppose, in the US, which suggests rising supply. And on top of that, OPEC production has recently spiked to a 3-year high. Changes in US legislation last week suggest that they'll shortly start exporting oil to Mexico, so that's adding to the supply side bias. And I think the key here from the chart standpoint is that the front month crude has broken uptrend support from the 2002 lows. You can see that quite clearly on the chart. So I don't see really
any reason to be long this.
Well, it's going to be, there's not much in the way of support now until we get back to those 2009 levels, and once there, sort of in the mid 30s, it's not that much of a stretch to think we could test back to the mid 20s as well.
Understood. Okay, Darren Sinden, market commentator, Admiral Markets. Thank you for that. Analysis. That wraps up the Wall Street Crossover Show. We'll be back same time tomorrow, 1 p.m. Thank you, Darren.
Thank you.